Hello and welcome. I'm Saeed from StoryPlanet.net. Dive right into the essence of the most captivating books without reading them cover to cover. Whether you're on the go, at the gym, or just relaxing at home, we offer you a unique and enriching listening experience. Today, we are exploring the book Fooled by Randomness, a creation by Nicholas Taleb. Fooled by Randomness, 2001, is a series of essays exploring the influence of randomness on financial markets and existence. By blending statistics, psychology, and philosophical contemplation, the author demonstrates the pervasive nature of randomness in our world. Before we delve into these revelations, it's interesting to note that Nicholas Taleb, a scholar, writer, and investor, has dedicated his life to unraveling the essence of chance, unpredictability, and wisdom. His book, The Black Swan, enjoyed widespread success, establishing him as a leading intellectual. Fooled by Randomness, another of his works, draws on his time as a Wall Street trader and personal encounters. With 9 key ideas to unveil, brace yourself for a deep dive into this captivating book. On StoryPlanet.net. To start, luck and randomness are commonly confused with skill and determinism. The text highlights how people often underestimate the role of luck and randomness in their lives, particularly in the stock market. It suggests that success in certain professions like plumbing or dentistry requires skills, but success in the stock market can sometimes be attributed to luck rather than skill. The narrative warns that relying solely on luck can lead to short-lived success followed by significant losses. It emphasizes the importance of recognizing the influence of luck and randomness rather than attributing success solely to skill and determinism. Key idea number 1. The text highlights the uncertainty of theories, explaining that change is constant and new observations can disprove existing beliefs. Empirical science relies on induction, where observations lead to conclusions about the world. The problem of induction, highlighted by the example of black swans, shows that no theory can be proven true, only false. This applies to investing as well, where assumptions must be constantly questioned. Past observations may not hold in the future due to changing conditions. Embracing uncertainty and being prepared for theories to be proven wrong is crucial in fields like investing, where adaptation is key. Key idea number 2. Life's unpredictability leads to unfairness and a lack of linearity. Success is not guaranteed for the most talented individuals. Evolution doesn't always lead to survival of the fittest. Some less fit organisms can persist. Path-dependent outcomes, like the QWERTY keyboard's prevalence, may not be optimal but endure due to inertia. Tipping points can lead even inadequate products to dominate the market due to positive feedback loops. Incremental efforts can lead to dramatic impacts, such as sudden breakthroughs after years of seemingly fruitless work. Life's outcomes are nonlinear, and extra effort can be disproportionately rewarded despite initial lack of visible progress. Life's unpredictability means the best don't always succeed. Key idea number 3. Reasoning is influenced by context and often relies on simple heuristics. Human reasoning relies on heuristics. Shortcuts evolved to aid quick decision-making. These shortcuts can lead to biases, such as attributing success to ability and failures to chance. Path dependency influences our thinking based on past routes taken. Despite being rooted in evolutionary usefulness, it can limit our ability to change opinions. It is crucial to recognize the limitations of our reasoning and be open to changing our minds when presented with contradictory information. Key idea number 4. Emotions can influence decision-making but may interfere with rational thinking. Emotions are essential in decision-making, acting as lubricants of reason that prevent us from getting stuck in indecision. They allow us to avoid situations like Buridan's donkey that needs a nudge to act. Emotions often precede rational reasoning, and they can overpower our ability to make sound judgments. Emotions can be managed by avoiding emotional triggers when necessary to protect our logical thinking. Key idea number 5. Patterns, causes, and explanations can be identified in past events but are generally ineffective for predicting the future. Humans struggle to learn from historical events due to hindsight bias, which makes past events seem more predictable after the fact than they were at the time. People tend to see patterns and causal relationships even in random data, leading to behaviors like gamblers' tics and reliance on backtesting trading strategies. While patterns may emerge from historical data, blindly trusting them for future predictions can lead to financial loss, as past success may simply be due to randomness. In hindsight, we may find explanations for past events, but they are not reliable for predicting the future. Key idea number 6. Humans struggle to accurately assess the significance of rare events. Hedge funds often overlook rare but impactful events, leading to unexpected losses. Outliers in data are frequently ignored in risk analysis, despite having the potential to greatly affect outcomes. Emphasizing probable events over improbable ones can lead to costly mistakes, as seen in both climate change research and investment decisions. Betting on infrequent but high-impact events can be a more sustainable trading strategy, despite being less appealing than frequent but risky wins. Understanding the significance of rare occurrences remains a challenge for investors. Key idea number 7. Embrace harmless randomness and employ stoicism to manage harmful randomness effectively. The text discusses how randomness can impact various aspects of life, from detrimental effects in finance to enjoyable elements in art and poetry. It emphasizes the importance of maintaining dignity and employing stoicism in the face of adversities caused by harmful randomness, while also appreciating and enjoying the harmless aspects of randomness. It highlights the control we have over our own behavior as a means of dealing with the unpredictable nature of randomness. Key idea number 8. Noise in media and stock markets should not be given attention. Obsessively reading daily news like the Wall Street Journal is effortful with little reward due to cluttered, mostly useless information. Stock market price movements are mainly random noise, fluctuating independently of underlying value. Emotional investors checking portfolios constantly experience more pain than pleasure as losses weigh heavier. Long-term, annual updates drown out noise and yield consistent returns, despite short-term emotional turbulence. Listening to random noise in media and markets is unproductive. In conclusion, the book highlights how we often misinterpret randomness as determinism, leading to various misconceptions. It explores the dominance of randomness in the world and why we struggle to acknowledge its impact. The text emphasizes that in areas like the media and stock markets, listening to random noise is usually unhelpful. It discusses how luck and randomness are frequently confused with skill and determinism, and it points out that life is unfair and non-linear. The book also touches on the limitations of our reasoning processes, the role of emotions in decision-making, and our tendency to find patterns in past events while struggling to predict the future. It suggests embracing harmless randomness and adopting stoicism to cope with negative randomness. Thank you for listening to this summary. If you enjoyed this exploration, we invite you to discover other fascinating books on storyplanet.net. Don't wait any longer. A multitude of books, stories, and knowledge await you there. See you soon on storyplanet.net.